In 1999, investors paid 44 times earnings for the S&P 500 and called it reasonable. 3 years later, they'd lost half their money. The P/E ratio tried to warn them. But most people have no idea how to actually read this number. Today, I'm going to fix that. Welcome back to Daily Investor. The price-to-earnings ratio is the most quoted number on Wall Street. Every financial news segment flashes it on screen. Every stock screener lists it in the first column. And yet, after 50 years of investing, I can tell you that most people who cite the P/E ratio are using it to justify decisions they've already made, not to make better ones. Today, I'm going to show you what the P/E ratio actually tells you, what it hides, and how legendary investors like Warren Buffett and Benjamin Graham use it as just one piece of a much larger puzzle. Let's strip this back to basics. The P/E ratio is simply the price you pay for every dollar of earnings a company generates. If a stock trades at $100 and earned $5 per share last year, the P/E is 20. That means you're paying $20 for every $1 of current profit. Think of it like buying a rental property. If a house costs $200,000 and generates $10,000 a year in net rent, you're paying 20 times earnings. At that rate, it takes 20 years of earnings to recoup your purchase price, assuming nothing changes. Now here's where most people stop. They see a low P/E and think cheap. They see a high P/E and think expensive. And that surface-level thinking has cost investors fortunes. Because the P/E ratio is a snapshot. It tells you what the market is paying today relative to what the company earned yesterday. It says nothing about tomorrow. In 2007, the big banks looked like screaming bargains. Citigroup traded at a P/E of around 8. Bank of America was near 10. Compared to the S&P 500 average of roughly 17, these look like steals. Investors piled in, pointing to the low P/E as proof. By March 2009, Citigroup had fallen from around $55 to under $1 per share. That low P/E was low for a reason. The earnings were built on a mountain of subprime mortgage exposure. When the housing market collapsed, those earnings didn't just shrink. They turned into massive losses. A P/E ratio can't warn you if the E is about to evaporate. Benjamin Graham called this the value trap. A stock that looks cheap by every standard metric but is cheap because the business is deteriorating. Graham wrote in The Intelligent Investor that a low price-to-earnings ratio alone is not enough. You must examine the quality and sustainability of those earnings. That advice was written in 1949 and it's still the most ignored lesson in investing. Now let's flip it around. In 2015, Amazon traded at a P/E ratio of over 500. 500 times earnings. Every traditional value investor called it absurdly overpriced. Some had been saying that since the P/E was 100. And yet, from 2015 to 2020, Amazon stock went from around $675 to over $3,000. A gain of roughly 340%. How is that possible? Because Amazon was deliberately suppressing earnings by reinvesting nearly every dollar back into the business. AWS, fulfillment centers, prime infrastructure. Jeff Bezos famously said, "Your margin is my opportunity." The P/E looked insane because the E was being kept artificially low. This is why Charlie Munger once said, "All intelligent investing is value investing, acquiring more than you are paying for." You just have to know what you're paying for. A P/E of 500 sounds insane until you realize you're buying a company that would triple its earnings power within 5 years. Context is everything. Now compare that to Cisco in March 2000. It traded at a P/E of about 196 during the dot-com peak. Investors told the same story: earnings will catch up to the price. But Cisco wasn't Amazon. Its growth rate couldn't justify that multiple. The stock fell from $77 to under $12 by 2002 and still hasn't recovered its year 2000 high, over 25 years later. Same concept, two opposite outcomes. The P/E ratio alone couldn't tell you which was which. You had to understand the businesses underneath the numbers. So if P/E alone isn't enough, how should you use it? The answer is, never in isolation. Always in context. First, compare PE within the same industry. A tech company at 30 times earnings might be reasonable when the sector average is 28. A utility company at 30 times earnings is probably overvalued when the sector average is 15. Second, look at the trend of earnings, not just the current number. Is the E growing, shrinking, or about to fall off a cliff? A PE of 15 on growing earnings is fundamentally different from a PE of 15 on earnings that peaked 2 years ago. Third, use the Shiller PE, also called the CAPE ratio. Robert Shiller's version uses the average of inflation-adjusted earnings over the past 10 years, which smooths out the cycle. As of early 2026, the Shiller PE for the S&P 500 sits around 35, well above the historical average of roughly 17. That doesn't mean the market will crash tomorrow, but it does tell you that investors are paying a premium relative to long-term norms. And fourth, always ask, why is this PE what it is? If a stock has a low PE, find out what the market knows that you might not. If it has a high PE, determine whether the growth story actually justifies the premium. Warren Buffett has said it plainly, price is what you pay, value is what you get. The PE ratio gives you the price side of that equation. Your job as an investor is to figure out the value side. Here's what I want you to remember from today. The PE ratio is a starting point, not a conclusion. It's the first question, not the final answer. Every investor who has lost money on a value trap bought a low PE stock without asking why it was low. Every investor who missed a generational compounder passed on it because the PE looked too high. The number itself is neutral. What matters is the story behind it. Learn to read that story by understanding the business, the industry, the earnings quality, and the growth trajectory, and the PE ratio becomes one of the most useful tools in your toolkit. Use it in isolation, and it's one of the most dangerous. If this helped you see the PE ratio in a new light, hit subscribe. We put out a new investing lesson every single day. Tomorrow, we're looking at one of the most overlooked investors of the 20th century and the simple strategy that made him billions. I think you'll find it fascinating. Drop a comment below. What's the most expensive PE you've ever paid for a stock, and how did it turn out? I'd love to hear your stories. This is educational content, not financial advice. Always do your own research.